Financial accounting. Anybody here online?
Yes, sir.
Sir?
I'm here.
Okay, you there.
Yes, sir.
So chapter 1 to chapter 9 we have covered so far. And today we have a target to cover 3 chapters, chapter 10, chapter 11, and chapter 12. Because all these 3 chapters are smaller, not bigger chapter. That's why we can cover in one day. Chapter 10 is about accruals and prepayments. Mean they are two topics. One is called accrual and one is called prepayments. Please prepare financial statements or record financial transaction on cash basis or accrual basis. So company record financial transaction either on cash basis or on accrual basis. What is cash basis? What is accrual basis? Let's discuss. Suppose there is a Dr. A. Dr. A charge its fee to patient as say $10,000. Dr. A charge 10,000 fee to its patients. If patient visit Dr. A, they charge $10,000. A patient visit Dr. A and after checkup by the doctor, patient have requested for some discount and they both agree with each other for 6,000 fee. So what Dr. A will record, debit cash 6,000, credit income 6,000. This is called cash based recording. Now move towards what is accrual based accounting. There is another doctor, Dr. B. And Dr. B also charge fee of $10,000. Dr. B also charge fee of $10,000. A patient visited Dr. B and after checkup, he requested Dr. B, I have 6,000 now that I can provide you. The remaining 4,000 I will give you in a next visit, on next visit. This means Dr. B will record cash debit of 6,000 and credit income. How much is income? 10,000. This means remaining 4,000 he will record as a receivable. And this is called accrual based accounting. Mean you will record the income fully, but you will gonna receive in future, so you will record it receivable. This is called accrual based accounting. Accruals mean uh, before discussing accrual, let's discuss one more example. Suppose this is our year end. Suppose our year end is 31st December 2023 when it was started 1st of January 2023. Mean before this was a previous year, after this there will be next year. Suppose all the expenditure relating to this year we will record in this year financial statements. If suppose there was electricity bill relating to this year and we're gonna pay in the next year like in January. So electricity bill was relating to year 23, but we're gonna pay in year 24. So this expense is relating to 23. So where we should record it? In 23. But we haven't paid cash. So how we will record it? We will record debit electricity expense. Say electricity expense is 1000 and credit we will say accruals, or we can say electricity bill payable. With how much? 1000. This is called accrual based accounting. Mean the benefit we have gained in current, but we're gonna pay in future. Mean the things relating to current year, but we gonna pay in future or we gonna receive in future. This will be called receivable or accruals. Instead of receivables here, we can record accruals. Mean the things expense or income. This is income, this is expense relating to current year, but that will be settled in future. Settled in future mean either we will receive cash in future or we will pay cash in future. That is called accruals. Mean income or expense of current year, but need to settle in future. In either we gonna receive cash against income in future or we gonna pay cash against expense in future. This will be called accruals. Mean relating to current year, but will be settled in future. Settle mean cash payment or receipt will be in future. So this is called accruals. And accruals could be either income, mean here it is income. What could be the accounting entry? Accruals debit, income credit. Our accruals could be expenses like expenses of current year, but we need to settle in future, mean we need to pay in future. What could be the entry? Expense debit, accruals credit. Can you understand this concept of accruals? Mean relating to current year, but will be settled in future. What are prepayments? Prepayments mean in advance. Suppose we have paid our rent of next year in current year as advance. Mean the benefit we will take in future, but we have paid the amount in advance. That is called prepayments. If suppose next year rent we have paid now in December, mean for 2024 rent we have paid in 2023. So that will be called prepayments in advance. And for prepayments, the accounting entry will be we have paid now. This means cash is gone, say 1000. But we will call debit prepaid. Prepaid expenditure. Or suppose from a customer we received cash now. Like here, to Dr. A, patient agreed like for every visit I will pay you 6000. Dr. A agreed, okay, I will charge you 6,000 for every visit, but if you pay 2 visit amount now, then I will charge you 6,000 per visit instead of 10,000. Suppose patient have paid 6,000 for this visit and he has paid in advance 6,000 for next visit. He has paid in advance for next visit. So that will be called prepaid. That will be called prepaid. And in that case, this means for doctor that 6,000 that he has received in advance, it's his liability, mean he need to either provide services in future or he need to pay the amount in future. So in that case, what he will record debit income, say 6,000, and credit he will record prepaid income with 6,000. Mean in case of prepaid expenses, we will debit it because we have paid in advance. This means this money we can receive in future or we can receive benefits of this money in future. So that's why we have debited the prepaid. And cash gone, obviously credit. Or we can say expense credit. But in case of income, prepaid income, we will credit prepaid and debit income. So what is accrual? Relating to current year, but will be settled in future. Mean expenses of current year, but we will pay in future. If we're gonna pay in future, that is our liability. So we will credit the accruals liability. Mean this expense will be recorded in profit and loss account, and this accrual will be recorded in statement of financial position as liability. And if our income that we need to receive in future, so what is the entry? Accruals debit, income credit. So income will go into profit and loss account and this accrual will go into statement of financial position, but as a asset because asset become debit and liabilities nature is credit. And in case of prepaid expenses, we have paid future expenses in advance. So entry will be prepaid expense, debit, expense credit, and expense will go into profit and loss account, while prepaid expense will be recorded as statement of financial position asset because debit. And if we have received future income in advance, prepaid will be credit. Income will go into profit and loss account and prepaid will be statement of financial position recorded as liability. So accruals mean relating to current year but need to be settled in future. Prepayments mean received or paid in current but benefits need to be provided in future are relating to future but settled in current year. Relating to future but cash either received or paid in advance. And this whole chapter is about accruals and prepayments. Let's discuss. So expenditure could be either accrued. If they are accrued, this means this is our liability that we need to pay in future. So the accounting entry will be debit, expense, credit, accruals. Or expenditure could be prepaid. Prepaid mean we have paid in advance. because against expenditure, we need to pay. Against income, we need to receive. If we have a paid in advance, so debit, prepaid, and credit, expense. In the similar way, income could be either accrued or prepaid. Accrued mean relating to current but need to be settled in future. This means we need to receive amount in future. In that case, we will record debit, accrue, the income, and credit income. Our income could be prepaid, mean in advance, mean we have received in advance, but we need to perform services, provide services in future. So in that case, we will debit income and credit prepaid income. So accrual basis accounting. What is the accounting entry of accrued expense? Expense debit, accruals credit. Illustration 1. A business electricity charges amounting to 12,000 per annum. Mean per year, its electricity expense is 12,000. In the year to 31st December 20x5, 9,000 has been paid. This means if per year is 12,000, you have paid 9,000. This means 3,000 still left, mean relating to current, but will be settled in future. The electricity for the final quarter is paid in January 20x6. And there are 4 quarters in a year. If suppose company year end is 31st December, so first quarter will be January, February, March. Second quarter will be April, May, June. Third quarter will be July, August, September. Fourth quarter will be October, November, and December. So the electricity bill for final quarter is paid in January. This means for this quarter, you have paid 3,000. This quarter, you have paid 3,000. This quarter, you have paid 3,000, mean 9,000 you have paid. And for this quarter, 3,000 you're gonna pay in future. So this will be called accrual. So what could be the accounting entry? Debit, electricity expense. How much? 3,000. And credit accruals. How much? 3,000. This will be recorded in profit and loss account as expense, and this will be recorded in statement of financial position as liability because it's on credit side. If it's accruals on debit side, that should be recorded as asset. Is that fine? So this is the accounting entry, electricity expense debit and accruals credit. Illustration 1. Jara's business has an accounting year end of 31st December 20x1. This is a year end 31st December 20x1. Jara's rents factory space at a rental cost of 5,000 per quarter. Mean he has rented out a building for his factory and the rent is 5,000 per quarter. Mean for the year, if there are 4 quarter, quarter 1, quarter 2, quarter 3, quarter 4, so 20,000 per year. Payable in arrears. What does that mean? Payable in arrears. In arrears mean will be paid in next. Arrears mean will be paid in next. Mean for the current period will be paid in next period. Mean for quarter 1 rent will be paid in quarter 2. Quarter 2 will be paid in quarter 3 and quarter 3 will be paid in quarter 4 and the rent for quarter 4 will be paid in next year quarter one. So during the year to 31st December 20x1, cash payments of rent were made as follows. On 31st March for quarter to 31st March, 5,000 mean for this quarter, 5,000 is paid. January, February, March. 29th June for quarter to 30th June. And quarter to 30th June is April, May, June, mean for this quarter, 5,000 paid. 2nd of October for the quarter to 30th September, mean for this quarter 3, July, August, September, 5,000 paid. The final quarter due on 31st December, mean for this quarter, the quarter to the date was not paid until 4th January, mean company haven't paid till 4th January, mean company is paying here. So how much? 5,000 is accrual. So we'll record debit, rent, expense with how much? 5,000, and credit accruals with how much? 5,000. This will be our accounting entry. They have recorded here. No, this is something different. This separate example. So now we are moving towards prepaid. Prepaid mean in advance. Mean we have paid the expenditure in advance, or we have received the income in advance. Expenditure we pay, income we receive. If we have a paid expenditure in advance, what will be the accounting entry? Prepayments, prepaid expenses debit and expense credit. Illustration 2. The annual insurance charge for our business is 24,000 per annum. Mean our per year insurance is $24,000. 30,000 was paid on 1st January 20x5. Mean if we pay 30,000, how much extra? Mean in advance we have paid 6,000. In respect of future insurance charges. So what could be the accounting entry? Debit, prepayments with how much? 6,000, and credit what? Insurance expense with how much? 6,000. Is that fine? This is the accounting entry: prepayments debit and insurance expense credit. Let's move forward. Test your understanding too. ISA pays the rental expense on a market stall in advance. And he paid rent expense in advance. ISA started business on 1st January 20x5, and on that date paid 1,200 in respect of the first quarter of rent. In quarter one, rent he paid how much? 1,200. During the first year of trade, ISA also paid the following amounts. 3rd March he paid in respect of the quarter ending 30th June. April, May, June mean it's relating to quarter two. How much he paid? 1,200. And 14th June he in respect of the quarter ending 30th September. July, August, September mean for quarter three he has paid 1,200. 25th of September he paid in respect of quarter ending 31st December, mean for quarter four he has paid 1,400. And on 13th December, mean current year, what's the current year? 31st December. On 13th December, in respect of the first quarter of 20x6, he paid 1,400. Mean for next year quarter one, he has paid 1,400 in December, mean paid in advance. So what could be the accounting entry? Debit, prepayments. How much? 1,400. And credit, rent, expense, 1,400. So this should be our accounting entry. Can you understand this? Okay, now let's discuss something else. If we look at expense account in ledger, this is debit side and this is credit side. In expense account, on debit side at start, we record prepaid expense brought down balance. On credit side, at the end, we record prepaid expense carried down balance, mean closing balance. And on credit side, at start, we record accrued expense brought down mean opening balance. And on credit side, we record accrued expense carried down mean closing balance. Because prepayments, prepaid expenditure are asset and asset is having a debit nature. That's why its opening balance will be on debit side. Obviously closing is on credit side. So next this will be transferred to here. Mean become debit for the next period. And accrued expense is a liability. And liability nature is credit. That's why accrued expense opening balance is credit. Closing debit. Obviously, this will be recorded here in next period. Is that fine? The expenses we charge to profit and loss account. In profit and loss account, expenses are debit. This means profit and loss account debit, expense credit, we will record here. And if we are paying any cash against expense, so cash going mean cash credit, expense debit. So that will be recorded here. So this is expense account. Prepaid expense opening balance will be on debit side, closing balance will be on credit side. Accrued expense opening balance will be on credit side, closing balance will be on debit side. Cash will be recorded on the expense account debit side because cash credit expense debit. So this ledger is a debit against cash. And the expense is charged to profit and loss account. In profit and loss account, we record expenses on debit while income on credit. So this means profit and loss account debit, expense credit. So profit and loss account item will be recorded here. Now let's discuss this question, test your understanding 3. On 1st January 20x5, Caro of 2000 in respect of previous year's electricity. What is that? Accruals are prepayments. In a start of year, you owed mean you need to pay previous year 2000 of electricity bill. This means expense relating to previous year, you're gonna settle now, mean relating to that year, settle now. It's an accrual opening balance. How much? 2000. Caro made the following payments during the year 31st December. Mean these are the payments during the year. If we total these payments, that is cash payments 2800 plus 3000 will be called will become 5800. So 2800 plus 3000 plus 2750 plus 3100 altogether 11650. So this is cash payment 11650. At 31st December mean at year end, Caro calculated that 1800 was owed in respect of electricity for the last part of the year, mean closing accrued is 1800. What is electricity charge to the statement of profit and loss account? You need to identify this balancing figure. So what you need to do, this side is looking bigger. So 11650 plus 1800, this will become 13450. We will write 13450 here and deduct 2000. So balancing figure is 11450. Which option? 11450, option B. Is that fine? Okay, moving to next. Now we are moving towards accrued income. Accrued income means relating to current, but against income we not gonna pay, we're gonna receive. Relating to current, but will be settled in future, mean receive in future. So what could be the accounting entry? Accrued income debit and income credit. Relating to current year, but we will receive in future. A business earns bank interest income of 300 per month. If 300 per month, what could be for year? 300 into 12, 3600 per year, per annum. 3000 bank interest income has been received. Out of 3600, you have received 3000. How much remaining? 600 that you're gonna receive in future. Related to current, will be settled, mean will be received in future. What is the year end asset and was in bank income? So what is the accounting entry? Debit accrued income. How much? 600. And credit interest income. How much? 600. So this will be recorded in statement of financial position. It's a debit. This means this will be recorded as asset because we're gonna receive in future. And this will be charged to profit and loss account as income. Is that fine? Prepaid income in advance. Prepaid mean in advance. Mean we have against income we pay or receive? Receive. We have received in advance. Mean money we have received in advance, but the services we need to provide in future. And the accounting entry will be income debit prepaid income credit because we need to provide services in future. Either we will provide services or we will provide amount. So this is due on us, mean liability. So we'll credit prepaid income in statement of financial position as a liability. So a business rents out a property at an income of 4,000 per month. If 4,000 per month, this means for year 4,000 into 12 will be 48,000 per annum. 64,000 has been received in the year 31st December 20x5, mean your rent income for the year is 48,000, but you have received 64,000. How much extra you have received? 16,000. For which either you need to provide a service in future or this amount. So what could be the accounting entry? Debit income, how much? 16,000. And credit prepaid income, 16,000. Is that fine? This chapter with one test to understanding left and complete it. What's that? accrued and prepaid income. Libby, Farquhar receive income from two rental units as follows. One is unit 1 and other is unit 2. From 1st October to 31st December mean this is 1 quarter relating to 20x4. You received this for unit 1 and this for unit 2. What we need to do? What is the Libby rental income in the statement of profit or loss for the year ended 31st December 20x5? So what could be the income for 31st December 20x5? So 31st December 20x5 will be this, because this will be for next year, this will be for previous year. So we can calculate simply add these four figures and add these four figures. So by adding these four figures, 2150 plus 2150 is equal to 4300. 4300 plus 4400, that will be 4700. And adding these 1300 plus 1300, 2600. And 2600 plus 2800, that will be 26 plus 28. 26 plus 28, that will be 5400. And if we add both of these, calculate please. 2150 plus 2150 plus 2200 plus 2200 is equal to 8700, sorry.
8,700.
And from other side, 1300 plus 1300 plus 1400 plus 1400, that will be 14100. So answer D. Simple. And this chapter is completed now. Now if we sum up this chapter. So there are two things. One is accrual and other is prepayments. Accrual mean relating to current, settled in future. Either we receive or pay cash in future. Prepayments mean in advance. Mean we have received cash in advance against future income, or we have paid cash in advance for future expense. If there is expense for accrued expense relating to current, need to pay in future against expense, we need to pay. So what could be the accounting entry? Debit expense, credit accrued expense. If it is prepayments mean in advance, mean we have a pay in advance. In case of accrual, we need to pay in future. Accruals mean in future. And prepayments mean in advance. Expense mean we have a pay in advance, paid in advance. So what we will call it debit prepaid expense and credit expense. In case of accrual, this will be our liability. In case of prepayments, this will be our asset. Now, for income and against income, we need to receive rather than pay. Accrued income in relating to current will be settled in future, mean we will receive in future. So what we record it, debit accruals, mean accrued income, and credit income, mean reverse of expense entry. And this will be our, if it's debit, will be recorded as asset. Because we have provided the service, but we're gonna receive cash in future. So that's why it's a asset, receivable. What is a prepaid paid income? In advance income mean we receive in advance. If we receive in advance, this means we need to provide a service in future. So what could be debit? Income. And credit, prepaid income. Because it's due on us. It's our liability. So this chapter is completed now. Let's take 10 minutes break so that after break with the fresh mind, we can start next chapter. So take 10 minutes break. Today we will take 2 10 minutes break because we're gonna take cover 3 chapters. So coming up. Sure. Okay. Let's start next one. Chapter 11. Are you there, Mr. Jauddin and Mr. Sadiq?
Yes, sir.
Okay. Let's start chapter 11. Chapter 11 is about receivables. Receivables. What is the accounting entry for cash sale? What's the accounting entry for cash sale? Cash is coming, so cash debit and credit sales. And for credit sale, debit receivable and credit. Receipt from the receiver. That is dash and credit also. The just how it recover credit our centers was on that can be receiver debit and sales that was more we need to receive money is it insolvent, bankrupt, or lost somewhere. This means we cannot receive this money from the that we call irrecoverable debt or we call it bad debt. Meaning case of confirmed bad debts, this money will not be recovered. How we can is as when we credit. So it will be correct. And debit will recover that benefits. Yeah. And so this is bad. That's not bad. Money receivable will not be risk. So it is called recovery. Accounting and recoverable debt expense bit receivable. We need to eliminate, we need to reduce that receivable. There's one more thing that is called allowance for receivable. Allowance for irrecoverable debt. What does that mean? Allowance for irrecoverable debt mean estimated amount that might not be recovered from customer. Mean receivable. Mean based on previous year bad debts, we can estimate an amount like this could be bad debts for coming year. Mean at start of year, we make our mind like might be we will not be recovered $10,000 in the coming year from receivables because these are normal bad debts. Because in previous year there was about 10,000 bad debts. So we have a make our mind. I mean, this is estimated, not actual. This irrecoverable debt is confirmed. This is not confirmed. This is estimated, might not be recovered. And if we are having any estimated amount that might not be recovered, that will be called allowance for irrecoverable debt. And we need to record this allowance for irrecoverable debt. How? Debit irrecoverable debt. But credit, we will not credit the receivables because this is not confirmed. So we are not eliminating receivables. We will credit allowance for irrecoverable debt. If there are confirmed bad debts, we are unable to receive money from customer. In that case, accounting entry will be irrecoverable debt expense, receivable credit mean we need to eliminate that receivable. But if there is estimation, mean not confirmed. So we need to record allowance for irrecoverable debt. How? Irrecoverable debt expense debit and allowance for irrecoverable debt credit. Obviously, if in future we recovered some amount from this, so what we will record debit cash and credit what? Irrecoverable debt. But there are very rare chances. So what we need to learn? What is the accounting entry for confirmed bad debts? Irrecoverable debt, debit, receivable credit. And what is the accounting entry for estimated bad debts? Mean allowances for irrecoverable debt. So irrecoverable debt debit, in both case irrecoverable debt debit. But now we will not credit receivable, we will credit allowance for irrecoverable debt or allowance for receivable. Is that fine? So let's discuss this chapter. So trade receivables could be either irrecoverable debt mean bad debts or allowance for receivable. Allowance for irrecoverable debt mean estimated, not confirmed. So this is confirmed. And this is estimated, mean not confirmed. So when we record cash sale, what is the accounting entry? Cash, debit, sales, credit. To record credit sale, what is the accounting entry? Receivable, debit, sales, credit. When we receive cash from receivables, cash, debit, and receivable, we need to eliminate by crediting it. Why company provide goods on credit basis? Mean what are the benefits if company providing goods to customer on credit basis? So the business may be able to enter new market, might be you have entered, mean you have started a new business, there are no customers. So you will attract customers. How you will attract a customer? By asking them to buy goods on credit basis. Okay, buy now, you can pay in future. So through this credit policy, company can attract the customers. There is possibility of increased sales if you provide credit services to the customer. Customer might be buying more, so you can increase your sale if you are providing goods on credit basis. If customer is not having a need, even he will buy because he will pay in future. Customer loyalty may be encouraged. Through this you can maintain customer loyalty. You can maintain long-term relation with customer. But selling goods on credit will be having some problems for the business as well. What problems the business have to face? Can be costly in terms of interest, since the business is accepting payment later. Obviously you have provided the goods now, but you will be receiving money in future. If you receive money now, you can put somewhere to generate any benefit, but you are losing your benefit. There may be some cash flow problem for the business, because business need to pay to the supplier in 30 days, but you're gonna receive from customer in 60 days. So for 30 different days, you might be facing cash flow issue. And there is issue of irrecoverable debt. Irrecoverable debt mean there are chances of bad debts, mean there are chances customer will not pay in future. Okay, let's discuss another topic called age receivable analysis. What is age receivable analysis? Suppose companies are having a different customer. One customer name is ABC. One customer name is XYZ. Other customer name is say PQR. Other customer name is say S2U, STU. Okay, from ABC customer, company have sold goods and they haven't paid the balance in the last 50 days. Balance is due for 50 days. For XYZ, the balance is due might be from 10 days. For PQR, the balance is due from 80 days. And for STU, the balance might be due for 3 days. If you are checking from how long your customer is having a due balance, that is called aged analysis of receivable. You are checking the receivable age, from how long they are having due balance. And you need to perform this on monthly basis so that you can recover money from them. Especially you have to immediately recover money from him, otherwise they will become bad debts, because from 80 days mean about 3 months the balance is due. After this you have to recover money from this, because this is also about 2 months. And after them you have to notify them like your amount is due. Obviously they can pay even in the next 10-20 days, that's fine, but you have to notify them. But for this you don't need to do anything, because there are only 3 days balance due. So might be after 10-15 days you can notify them, please pay your balance. But for this you have to take action immediately, otherwise there will be chances of bad debts. So at the end of every month, company need to perform aged analysis of their receivable. Aged analysis of their receivable mean checking the age of receivables. Checking the age of receivable mean checking from how long their balance is overdue. So let's read. Where credit facilities are offered, it is normal for a business to maintain an aged analysis. Analysis is usually a list order by name showing how much each customer owes and how old their balances are. The credit control function of a business use the analysis to keep track of outstanding debt and follow up any they are overdue. Because if you don't follow up, especially these people, there will be bad debts. So timely collection of debt improve cash flow. If you don't collect, you will be facing cash flow issues and reduce the risk of them becoming irrecoverable. Obviously, if you don't ask them, don't recover them because you don't know their balances from how long is due, there will be chances of bad debts. Let's discuss one more topic called credit limits. What is credit limit? Credit limit. There are different types of customers. Some are very old, some are old customer, and some are our new customers. And we provide some credit to the customer. Like the customer who are very old, mean they are with us from last 10 years. Might be we have offered them like you can buy from us up to 10 lakh dollar product on sale. Mean we allow them 10 lakh dollar credit. Mean they can buy from us on credit basis up to 10 lakh. And to the old customer might be we have a credit limit set of 5 lakh. Mean they can buy from us up to 5 lakh on credit. And for new customer, because they are new, we will set lower credit limit like only up to 100,000 they can buy us from on credit. As they become old, we will increase their credit limit. As they become very old, we will increase their credit limit because as the customer are becoming old, they are our loyal customer. They are moving towards loyal customer, and to loyal customer, we provide more credit facility. For new, we provide less credit facility because they are new. We don't know from how long they will continue with us. So it is also normal for a business to set a credit limit for each customer. And this is the maximum amount of credit that the business is willing to provide. The use of credit limit may reduce risk to business of irrecoverable debt by limiting the amount sold on credit. Reduction will reduce chances of bad debts. Help build up the trust of new customers so we can increase credit limit. Be part of the credit control strategy of our business. Mean to loyal customer, mean old customer, we provide more credit, and for new customer, we provide less credit because there are chances of bad debts. Is it fine? Okay, now moving towards our chapter. Irrecoverable debt mean confirmed bad debts, and the accounting entry for confirmed bad debts is irrecoverable debt expense debit receivable credit. Allowance for receivable or irrecoverable debt, we can call it allowance for receivable, mean estimated amount, not confirmed. That accounting entry is irrecoverable debt debit, allowance for receivable credit, allowance for irrecoverable debt, or you can say allowance for receivable is credit. Not receivable. So let's discuss some questions on this area. So irrecoverable debt and allowance. Accounting for irrecoverable debt, and irrecoverable debt is a debt which is or is considered to be uncollectible, mean confirmed bad debts. The accounting entry will be irrecoverable debt expense debit receivable credit. Test your understanding one. RF and company has a total account receivable at the end of accounting period is 45,000. Let's discuss receivable ledger balance first. receivable account. Receivable is asset or liability? It's asset. And asset is having a debit nature. So their opening balance means balance brought down will be recorded on debit side, and their closing balance means balance carried down will be recorded on credit side. What is the accounting entry for credit sale? Receivable debit, sales credit. This means receivable debit, sales credit. So we will record sales on the debit side. If we receive cash from receivable, so cash debit, receivable credit. So we will record cash here. And what is the accounting entry for irrecoverable debt? Irrecoverable debt expense, debit, receivable credit. So we will record irrecoverable debt here on credit side. Or we can say opening balance. If we add sales to opening balance, deduct cash received and deduct irrecoverable debt, we will arrive at closing balance of receivable. In opening balance, add sale minus cash received minus irrecoverable debt, we can arrive at closing balance of receivable. Okay, let's discuss. RF and company has total account receivable at the end of accounting period of 45,000. Of these items, it is discovered that one MRX who of 790 has been declared bankrupt. Mean this will not be recovered. And another who gave the name of MJO has disappeared owning 1240. So calculate the effect in the statement of writing of these debts as irrecoverable. What is the accounting entry? 1240 plus 790 is irrecoverable debt. So debit irrecoverable debt expense. How much is the total? 1240 plus 790. 1240 plus 790. 2030. And credit what? Receivable. How much? 2030. This means in profit and loss account, we will record 2030, and in statement of financial position under asset, we will record receivable with how much amount? 45,000 less irrecoverable debt of how much? 2030, with the remaining amount receivable should be recorded. And what is the remaining amount? 42970. So this figure will be recorded as asset in statement of financial position, and this will be recorded in profit and loss account. Can you understand this? Okay, let's move forward. So accounting for irrecoverable debt expense, debit, receivable, credit. And if we receive cash from receivable, cash, debit, receivable, credit. And in rare cases, if we have recorded allowance and we receive cash, so cash, debit, irrecoverable debt, credit. Let's move towards test your understanding 2. Fisher had receivable 3655 at 31st December 20x7. At that date, a debt of 699 from lakhs was written off. Mean bad debts. This means receivable balance at 31st December. 31st December 20x7 will be 3655 minus 699. How much? 3655 minus 699. 2956. So this is balance carried down for 20x6 and brought down for 20x8. So during the year 31st December 20x8, Usher made credit sale of 17,832. So this is balance brought down for 20x8 and the sales will be added to this. How much credit sales are there? 17,832 sales. And received cash from customer totaling 16,936 and minus cash received how much? 16,936. Usher also received the 699 from lakhs that had previously been written off. And if previously any amount written off, the accounting entry was irrecoverable debt, receivable credit. Now the accounting entry will be cash debit, irrecoverable debt debit. Mean will be having no effect on the receivable. So what could be the balance at 31st December 20x7 and 20x8 for receivable account? So for 20x7, the balance will be 2956. And for 20x8, you can calculate how much? 2956. Add 17832 minus 16936. So that will be 3852. This is balance carried down for 20x8. This is carried down 20x7 or brought down for 20x8. So option. Okay. You know, can you understand this? Let's move towards allowances for receivable. What is allowances for receivable mean? Estimated, not confirmed. There may be some debt included in the accounts, mean receivable included in the accounts where there is some cause for concern, but which are not yet definitely irrecoverable, mean haven't been confirmed. It is prudent to recognize the possible expense of not collecting the debt in the statement of profit or loss. Mean that's why irrecoverable debt expense debit, but the receivable must remain in the account. That's why we are creating allowance for receivable. In the case customer does in fact settle the amount outstanding, mean there are chances might be this is recoverable. The accounting entry for allowances for receivable, irrecoverable debt expense, allowance for receivable credit rather than receivable credit. Illustration 1. On 31st December 20x1, Azaria had receivable of 10,000 when at the end of 20x1, the receivables are 10,000. At that date, Azaria estimated that there was evidence that amount totaling 300 may not be recovered as these receivables were already overdue and therefore wanted to make a specific allowance for this amount. Are they confirmed? I mean, irrecoverable debt or allowance for receivable? Estimated mean allowance for receivable. This means receivable balance is 10,000 and irrecoverable debt is 300. Irrecoverable debt to debit and allowance for receivable credit. During 20x2, Azaria made sales on credit totaling 100,000. This means for 20x2, this will be opening balance. So sales are how much? 100 thousand. We will add to it. And received cash from customer 4,000 and cash received we will deduct. And at 31st December 20x2, Azaria now considered that there was a doubt regarding the recoverability of amount totaled 700, which were overdue and which may not be received. Mean they are having doubt, not confirmed. And the allowance for receivable should therefore be increased from 300 to 700, mean 400 more added to it, it becomes 700. It's not confirmed. Again, having doubt. Is that fine? This means at year end 20x2, what could be the balance? 10,110 minus 94. 16,000 will be balance, opening balance at the start of 20x3 mean next year. So during 20x3, Azaria made sales 95,000. So 95,000 sales will be added. And collected 96,000 from receivables and 96,000 is cash received that should be deducted. At 31st December 20x3, Azaria now considered that amount totaling only 600 required an allowance for being overdue at that date. Mean instead of 700, allowance should be 600. So what's the remaining 100? That is irrecoverable debt. The allowance for receivable should therefore be adjusted from 700 to 600. This means that 100 is becoming bad debts. So bad debts we also deduct. So what's the calculate the allowance for receivable and irrecoverable debt expense as well as closing balance of receivable for 20x1, 20x2 and 20x3. So 20x1 balance is 10,000, 20x2 balance is 16,000 and 20x3 balance will be, if we deduct 1,000 extra, 15,000, 15,000 minus 100, 14,900. So these are the balances. And for allowance for receivable, this will be 600. You know? And this chapter having one more question and then complete it. Kobe had opening balance at 1st January 20x6 of the receivable account and allowance for receivable account 6 of 68,000 and 3,400 mean at 20x6. Receivable opening balance is 68,000 and allowance for receivable how much? 3,400. During the year to 31st December 20x6, Kobe made credit sale of 354,000. So 354,000 will be added to it. And collected cash from receivable 340,000 and 340,000 will be deducted. This means closing balance will be 68,000 plus 354,000 minus 340,000. So closing balance will be 388,000. At 31st December 20x6, Kobe reviewed the receivable listing and acknowledged that it is unlikely to receive debt totaling 2,000, mean these are confirmed bad debts of 2,000. And these are to be written off as irrecoverable. This means 2,000 more we need to deduct. This will become 386,000. These are to be written off as irrecoverable. In addition, at the date, Kobe estimated that amount totaling 4,000 were overdue and that an allowance for receivable was required to cover these amounts. Mean allowance should now be how much? 4,000. Before it was 3,400. How much we have added more? 600. And they have asked me what is the irrecoverable debt expense. So irrecoverable debt is 2,000 this and 600 this. Altogether, how much? 2,600 irrecoverable debt. C option. Is it fine? This chapter is also completed. There is nothing left in this chapter. So let's take one more break. After break, we will move towards next chapter. Coming after 15 minutes. I'm back. Are you there?
Yes, sir.
Yes, sir.
Okay. Let's start next chapter, chapter 12. It's another small chapter. It's based on three things. One is payable, one is provision, third one is contingent liability, and fourth one is contingent asset. Payable, provisions, contingent liability, contingent asset. What is the accounting entry for credit purchases? Debit purchases, credit payable. What is payable? It's current liability, in where it is recorded in statement of financial position as current liability. So payable is a liability. Simple. There's nothing more. Payable is liability. Payable is liability. Provision is also a liability. And where liabilities are recorded? In statement of financial position. While contingent liability, contingent asset, they need to be disclosed only, mean there is no accounting entry of contingent asset and contingent liability. What are they? We're gonna discuss now. For payable, accounting entry is purchases, debit, payable, credit. For provision liability, accounting entry will be debit, expense, and credit provision liability. The accounting entry of payable is debit, purchases or expense, credit, payable. For provision, accounting entry is expense, debit, provision liability, credit. And contingent liability, contingent assets, there is no accounting entry for them. They need to be disclosed in the financial statements, mean they are not part of profit and loss account, not part of balance sheet, not cash flow, not changes of equity. They need to be disclosed in notes to the accounts. There is no accounting entry of contingent liability and contingent asset. Okay, let's discuss when we need to record provision. Provision should be recorded if any event meeting three conditions. If any event meet three conditions, there should be provision. What are those three conditions? Number one, present legal or constructive obligation from past event. Present legal or constructive obligation from past event. Number two, probability of future economic, mean money outflow. And number three, amounts can be measured reliably. If any event meeting these three conditions, there should be provision, mean expense, debit, provision, credit. If any of these condition is not fulfilled, no provision should be recorded. Suppose company sold goods to customer for $100 and company sold food items to customer for $100 and those food items were expired. Even at the time of buying, customer was not aware. At the time of sale, company was not aware. But those food items were expired. Customer used those products and suffered serious health issues. And now customer has sued the company, file a case against company for damages of $100,000. So he bought goods for 100. And due to those expired products, he suffered his health badly. For so many weeks, he was unable to do anything. He lost his income, might be he lost his job, and he sued the company for damages of 100,000, like company need to pay the damages of 100,000. This is an event or case against the company. If this event is meeting these three conditions, company need to record provision mean debit, expense, and credit provision. For how much amount? Obviously 100,000. What does that mean condition? There should be present legal obligation. I'm leaving constructive from now. Present legal obligation mean there is obligation if he have a file a case in the court. So there is a legal obligation on company that arises from past event. Obviously, in the past, company done something, mean company sold goods to customer. So this condition is fulfilled. Probability of future economic outflow means there are chances. Probability means chances that company need to pay outflow mean amount. Probability mean if chances are more than 50%, then there is probability. And amounts can be measured reliably, mean how much amount, mean how much will be outflow in money terms, economic mean money terms. That amount is known. Obviously, that amount is 100,000 known. So this means this is meeting all three conditions of provision. So company need to record provision, expense debit, and provision credit with 100,000. If there is no obligation, like a customer is an idiot, he suffered his health due to some other issues rather than by using this product because these products were not expired, then there is no obligation on the company. But if those products are expired and he has approved, this means there is obligation on the company because company need to check before selling the products should not be expired. And if there are chances less than 50%, mean there is no probability. In that case, there is possibility. When there is possibility, chances less than 50%, mean there are more chances that company will succeed. If chances more than 50%, mean there are more chances customer will succeed. And if there is a possibility, this condition is not met. If there is a probability, mean chances more than 50%, this means this condition also met. And if the amount is known, how much amount company need to pay? Obviously, customer have sued damages of 100,000. This means amount is known. If amount is not known, then third condition is not met. There shouldn't be any provision. Can you understand this? Mean present legal obligation mean court can decide that a company is guilty. And chances are more than 50% of outflow mean future payments. Outflow mean future payments in money terms. And how much company need to pay in future, the amounts is also calculated. If there is no obligation, there will be no provision. Or if there are chances less than 50% mean not probability, possibility, there will be no provision. And if amount is not known, there will be no provision because we need to record accounting entry with the amount. If amount is not known, how we can record accounting entry? We cannot record accounting entry. Is that fine? Can you understand this? If there is a probability, there should be provision. If there is a possibility, in that case, there shouldn't be any provision. In that case, it will be considered as contingent liability. Mean there should be only a disclosure in the financial statements, no need for accounting entry of provision. When provision should be recorded, mean liability provision should be recorded when any event meeting these three conditions. Present legal obligation from past event, probability of future economic outflow, and amounts can be measured liably. If any one of the condition is not fulfilled, no provision should be there. And if instead of probability, there is a possibility, mean chances are less than 50% that company need to pay damages. In that case, it should be disclosed as contingent liability. What is contingent asset? We will discuss later on. So payable is a liability. Provision is also liability in case these three conditions are fulfilled. And contingent liability, contingent asset will be disclosed when there will be contingent liability, when there is a possibility of future economic outflow rather than probability. Possibility means there are chances company will be successful not paying the amount. Probability, no, there are chances customer mean other party will be successful, company will be found guilty, mean company need to pay the amounts. More chances company need to pay the amounts. So let's discuss this chapter. Liabilities are of two types. Current liabilities, non-current liabilities. Current liabilities that we need to settle within 12 months and non-current that we need to settle in more than 12 months. What are the current liabilities? Payables, short-term loan. What are the non-current liabilities? Bank loan, debentures, leases, and liabilities of uncertain timing and amount are called provision and contingent liability. And we have discussed what are the three conditions: present legal or constructive obligation from past event. What is meant by constructive? We haven't discussed yet. So let's discuss what is constructive obligation. Suppose a company has provided warranty to its customer for 1 year. Like if there is any issue in our product, within a year, you can claim warranty. And if company has provided warranty, this means there will be chances some customer will return the goods and claim warranty. And if company have a provided warranty and they have a published, this means there is a present constructive obligation from past event, meaning past you have sold, provided warranty, and this obligation is not imposed by any other party. This obligation is constructed by the company himself by providing warranty because they have published it. And if you have published it, obviously within 1 year, if there is any issue with the product, customer can claim damages, can claim warranty. And there are chances, obviously, if you have provided warranty, there are not more than 15, in fact, 100% chances if the product is faulty, customer can claim damages. And the amounts can be measured reliably. This means if company have provided warranty, there are chances of future outflow. So company need to create provision with how much amount that will depend upon past warranty claims. Mean in previous year, how much claims customer have received against warranty. Mean how much you pay to the customer against warranty. Suppose that figure is a 50,000. This means for 50,000, you need to create provision. Expense debit, provision credit. So present legal obligation mean obligation has been imposed upon you by any other party, like through court. Constructive, you have constructed obligation from yourself, like you have provided warranty. So that warranty is obligation that you have constructed by yourself. Can you understand this? So liabilities are of two types, non-current liabilities, also called long-term liabilities that we need to pay in more than 12 months, for example, loan, leases, and current liabilities that we need to pay in 12 months, like payables, bank overdraft, or short-term loans, so like 6 or 9 months loan. So what is liability? A present obligation of the entity to transfer an economic resource, mean we need to pay cash as a result of past event because we have bought something in the past on credit basis, or we have done something in the past that we need to pay. And IAS 37 is covering provision, contingent liability, and contingent assets. And when provision should be recorded, the payable accounting entry is purchased. If we purchase goods on cash basis, the accounting entry will be purchase debit, cash credit. And if we are buying goods on credit basis, the accounting entry will be purchases debit and payable credit. Purchases debit and payable credit. And when we pay cash to the payable supplier, payable debit and cash credit. Now move towards what is provision. A provision is a liability of uncertain timing or amount. When we need to pay, it's not decided, but we need to pay. There are more than 50% chances. And when provision should be recorded, the accounting entry for provision is expense debit, provision liability credit. And by meeting three conditions, we need to create provision. Entity has a present obligation, legal or constructive as a result of past event, probability of future economic outflow, and amounts can be measured reliably. Let's discuss this illustration one. The criteria referred to above mean that a provision can only be recorded in accounting period if recognition of a liability has been triggered at the year end. Mean if meeting three conditions. For example, Smith Company's year end is 31st December 20x7. So year end is 31st December 20x7 when it started 1st January 20x7. In a November 20x7, before year end, here will be November. Smith Company dismissed an employee. Here, they dismissed an employee. And if you have dismissed that employee unfairly, employee can sue you for damages. If you have dismissed him fairly, that's fine. But if he has proved in the court, you have dismissed him unfairly, in that case, you need to pay him damages. In February, after year end, here February 20x8, a customer slipped while on Smith Company premises and broke an arm. There was a wet floor and a customer came into our business and he slipped and broken his arm. And if the floor was wet due to company problem. Obviously, if the floor is wet, company need to put a yellow sign over there, should be indication like a floor is wet, so that everybody should be careful. And if the floor was wet, I mean there was water because of your company problem and you didn't put the yellow sign, mean warning sign, and customer while moving has slipped and broken his arm, he can also sue you for damages. So in March 20x8, mean after year end, here in March, both the employee and injured customer sue Smith company for the damages. The former mean employee for unfair dismissal and the latter for compensation for injury suffered on Smith company premises. So when company dismissed the employee before year end, so this means this was a past event. And if there is a present legal obligation of obviously he has a suit in the court, and if there is a probability of economic outflow and the amount is measured reliably, then for employee dismissal case there should be provision. And for customer where he slipped here, so it's not meeting present legal obligation from past event because this is future event. This is year end. So event should be before year end. As this is not meeting the first condition, so there shouldn't be provision. So should an obligation be recognized? Recognized mean recorded as provision at 31st December or not? See the answer. There is a potential obligation at the year end for the employee because this is past event. And this is because the triggering event happened in November, which is before the year end, mean past event. There is no obligation to the injured customer at 31st December because this event happened after the year end. This is not past event, this is future event. In the next year might be, it will be provision in 20x8, not in 20x7, mean current year. Therefore, any financial consequences resulting from the claim made by customer will be reflected in the financial statements for the next year, mean 20x8, not in current year. So what is the accounting entry for provision expense debit, provision credit? In case of increase of provision, and there are very rare chances there is decrease in provision. In that case, we need to reverse the entry. Illustration 2. Curing entity. Curing means a company who have installed a machinery for mining. That company is called curing company, who have installed a machinery for mining. Obviously, if you are mining something from the earth and you have installed any machinery, so through your operation, there will be chances of pollution. So a curing entity has a legal obligation to make good any environmental damage caused by its operation upon completion of its curing activities. You need to repair the environmental damages from your operation. If you don't repair, there will be obligation. The curie is expected to be operational for 8 years, commencing 1st January 20x1. And at 1st January 20x1, the estimated cost of making good the environmental damage is 80,000. Ignore the discounting. That company need to bear. During 20x5, the estimated cost of making good the environmental damage was reassessed to be 85,000. Mean 5,000 more increased. How would the provision be accounted for in the financial statements for the year ended 20x1? So for 20x1, accounting entry should be debit environmental damage expense, environmental expense. With how much amount? 80,000. And credit provision with 80,000. And how would the movement in the provision be accounted for in the financial statements for the year ended 31st December 20x5? Obviously 5,000 more. So debit environmental expense debit with 5,000 and credit will be provision with 5,000. Is that fine? So this accounting entry they have recorded. Let's move forward. What is contingent liability? Contingent liability is defined as a possible obligation that arises from past event and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future event. Mean whether company need to pay the amount or not, this will be decided in a future. Present obligation that arises from past event but is not recognized because it is not probable, mean possible. In that case, we need to record, disclose contingent liability. So say we have discussed payable, we have discussed provision, and we are discussing contingent liability. Payable must be recorded as a liability. Provision always should be recorded as liability. For contingent assets, there are contingent liability, there are three accounting. Either it will be recorded as a liability, either it will be disclosed, or either it will be ignored, mean do nothing. Payable is always recorded as a liability. Provision, if meeting three conditions, will be recorded as a liability. And contingent liability, if chances are greater than 50% of payment will be recorded as a liability. If chances are less than 50%, mean possibility rather than probability. In that case, it will be disclosed. And if chances are less than 5%, it should be ignored. Mean do nothing part. If chances are between 5 to 50%, this means there is a possibility it should be disclosed only. And if any event, the chances of payment are more than 50%, it should be recorded as a liability, mean provision. And if there are chances of less than 5% to make payment in future, in that case, we should ignore that. Is that fine? So let's move towards our start point again. So when we need to record the provision, if any event is meeting these three conditions, present legal or constructive obligation from past event, probability of future economic outflow mean payment, mean more than 50% chances, and amounts can be measured reliably. In that case, there should be provision. If there is a possibility, mean chances are less than 50%, so there will be possibility. In that case, no provision, we need to disclose contingent liability. Now discuss if there is probability, mean more than 50% chances of future economic inflow, Not outflow, inflow mean receipt. In that case, we need to disclose contingent asset. It should be disclosed. No accounting entry of contingent liability or contingent asset. They only need to be disclosed. So in case of possibility of future outflow, contingent liability, not probability, possibility. But in case of probability of future inflow, contingent asset should be disclosed, not a possibility. In case of contingent asset, there should be probability of inflow. Mean we have sued the others and there are more than 50% chances we will recover the amount. Like customer sued us, we sued the supplier. He provided us expired goods. And if there are more than 50% chances we will receive amount from the supplier, more than 50% chances mean probability. In that case, we will disclose contingent asset. If less than 50% chances, we will ignore. There shouldn't be any contingent asset. Can you understand this? Payables, provision, contingent liability, contingent asset. This is a bit difficult topic at this level. So let's move forward. Let's discuss one more question. Okay, see here. If there is a probability of future economic outflow, in that case, provision should be recognized mean liability. And along with provision, we need to provide disclosure as well. In case of contingent asset mean, in case of inflow. If there is outflow, here inflow. So if we discuss about this only, if there is a probability mean chances are greater than 50% provision. If there is a possibility mean chances are less than 50%. In that case, contingent liability should be disclosed. If remote mean chances are less than 5%. In that case, it should be ignored. In case of outflow, mean chances of payment. And if there are chances of receipt mean inflow and probability of future economic inflow, in that case, we need to disclose contingent asset. If there are possibility of inflow, we should ignore. If there is a remote mean 5% chances of future inflow, we should ignore. Mean when we should disclose contingent asset, when there are probability of future inflow, receipt, asset, receiving, liability, paying, payment. And this has been explained again. Probability mean chances are above a 50% mean between 51% to 95%. Possibility mean chances are below 50% mean between 5% to 50%. And remote mean chances are below 5%. And if there are chances of more than 95%, that is virtual certain. In that case, liability. Probability in that case, provision liability. And possibility in that case, contingent relating to future contingent means relating to future contingent liability disclosure. And if there are less than 5% chance of future payments, in that case, it should be ignored, do nothing. So let's discuss this illustration 3. A retail store has a policy of refunding purchases by dissatisfied customers. Mean company has a policy of refunding purchases, mean providing warranty. And if customers are dissatisfied with the product, they can make refund. For example, when goods have been purchased and the customer decide that the goods are the wrong size, color, or style, even though it is under no legal obligation to do so. I mean, there is not law defined, but company himself providing this warranty. I mean, there is constructive obligation. Its policy of making refund is publicized, and if company has publicized, this means obligation arises in the store and in the advertisements. The retail store has a year-end date of 31st December 2026. Should a provision be recognized in the financial statements for the year ended 31st December 2026 for the goods sold? Yes, company need to create provision. With what amount? Previous year warranty claim or purchase return amount. What's the answer? The policy is well known and creates a valid expectation that the store will give refund to customers who return goods. At the year end date, there is a constructive obligation. I mean, company has constructed by himself, not imposed by any court or law. It is probable some refunds will be made. Obviously, customer will claim. The obligation can be reliably measured from past claims, perhaps by using expected values based on past experience of what a proportion of value of goods sold are actually returned by the customer. So conclusion, a provision is required and a reliable estimate of the amount should be made for inclusion in the financial statement. Test your understanding one. What you need to do. State with reasons. What adjustment, if any, should be made by Madras in the financial statements? Mean where company need to provide provision, where company need to disclose contingent liability or contingent asset or simple liability. We need to provide with reason. And there are three different cases that we need to deal separately. So the draft financial statements of Madras, an entity for the year ended 31st December 2026, are currently under review. The following points have been raised. Can you read this number one and see whether there is a chance of provision or contingent liability by yourself? Giving you 2 minutes. Are you there? So number one, an ex-employee has started an action against Madras for wrongful dismissal. This means there is present legal obligation from past event. The entity's legal team in lawyer have stated that an ex-employee is not likely to succeed. Not likely to succeed means there is no probability, means there is only possibility. If it is likely to succeed, means chances are more than 50%. Not likely to succeed means less than 50%. The following estimates have been given by the lawyer relating to the case. Legal cost to be incurred whether the claim is successful or not 5,000, and settlement of claim if successful is 15,000, means there will be 20,000 amount. Currently no provision has been made by Badras in the financial statements as it is not likely to succeed, mean there is possibility not probability, so there should be contingent liability disclosure rather than provision. Is that fine? Now move towards number 2. Please try by yourself whether provision is required or not. So Madras has a policy of refunding the cost of any goods returned by dissatisfied customer, mean company is providing warranty. And if they are providing warranty, there will be chances of customer warranty claim. Even though it is under no legal obligation to do so, this policy of making refund is generally known. And at the year end, Madras reliably estimated that return totaling 4,800 will be made after the year end. So meeting all 3 conditions of provision. So there should be provision, liability on what amount? $4,800. Number 3. Try by yourself. Number 3, a customer has made a claim against Madras for injury suffered following the purchase and use of defective products. Might be product was expired or something. He has suffered injury, means suffered his health. Legal advisor has confirmed that Madras will probability have to pay financial compensation of 100,000 to the customer. Amount is also there. Probability is there. So for this, there should be provision liability of $100,000. In turn, Madras has made a counter claim against the supplier because might be supplier provided you defective products of the defective products for 100,000 and believe it is probable that its legal claim supplier will be successful, mean probability of a future inflow. So if there is probability of future economic inflow, in that case company need to disclose what contingent asset in financial statement. There is no accounting entry of contingent asset or contingent liability. And this chapter is completed now. Mean per IAS 37, we need to record provision as a liability. And we need to disclose what contingent asset, contingent liability. There is no accounting entry for them. And this chapter is completed. So that's enough for today. Hope to see you in next lecture with something new.